June 30, 2007, a date that would later be etched into Wall Street history as the day the first domino began to tip, when Bear Stearns warned investors that its hedge fund, Bear Stearns High Yield Capital Management, could not meet a $2 billion margin call. The shock reverberated through the financial world, but few could have imagined that this warning was merely the opening act of a tragedy that would see the venerable firm, once a titan of American finance, crumble under the weight of its own ambition. Founded in 1923 by brothers Joseph and Robert Bear and Henry Stearns, Bear Stearns began as a modest brokerage house on Wall Street, trading municipal bonds for a handful of local investors. By the 1960s, the firm had embraced the emerging culture of mergers and acquisitions, positioning itself as a deal-maker's ally. In the 1980s, under the leadership of Alan Vase Greenberg, Bear Stearns transformed into a powerhouse of high-yield securities, pioneering the junk bond market that fueled the era's leveraged buyouts. The firm's aggressive, almost feral trading floor earned it a reputation for speed, daring, and an uncanny ability to read market currents before anyone else. The 1990s saw Bear Stearns riding the wave of the dot-com boom. Its investment banking arm underwrote some of the most iconic tech IPOs, while its sales and trading desks capitalized on the surge of internet-related equities. Revenues swelled, and the firm's stock price rose in tandem, cementing its status as a Wall Street elite alongside Goldman Sachs and Merrill Lynch. By the turn of the millennium, Bear Stearns was a $16 billion enterprise, its name synonymous with bold risk-taking and relentless profit. Yet beneath the glossy veneer, warning signs flickered. The firm's rapid expansion into mortgage-backed securities in the early 2000s was a double-edged sword. While the market for these assets boomed, Bear Stearns accumulated a staggering $30 billion in exposure to subprime mortgages, much of it tucked away in off-balance sheet entities designed to evade regulatory scrutiny. Its famed risk-adjusted return model, lauded for delivering outsized gains, began to mask the growing concentration of toxic assets. Internally, analysts raised concerns about the firm's leverage ratio, hovering above 30-to-1, far higher than the industry norm, a precarious position should the housing market falter. The first tremor came in early 2006, when the housing bubble began to show cracks. Default rates on subprime loans ticked upward, and the market for mortgage-backed securities grew jittery. Bear Stearns' senior partners, however, brushed aside the murmurs, confident in their ability to offload risk through complex derivatives and hedging strategies. The firm's culture, celebrating the next big trade over prudence, reinforced a collective denial that would prove fatal. By the summer of 2007, the situation had deteriorated dramatically. Bear Stearns High Yield Capital Management, the firm's flagship hedge fund, faced a mounting margin call from its prime broker, JPMorgan Chase. The fund's assets, heavily weighted in mortgage-backed securities, were plummeting in value as the subprime crisis accelerated. When the fund could not raise the required capital, Bear Stearns was forced to liquidate assets at fire sale prices, igniting panic among investors and counterparties alike. The June 30 warning that sparked the initial shock was a harbinger of the storm to come. The panic spread like a contagion. On March 14, 2008, a group of Bear Stearns creditors, including the Federal Reserve Bank of New York, convened a frantic meeting to discuss the firm's solvency. Within hours, the firm's stock, once trading above $150 per share, sank to under $70, erasing billions in market capitalization. Rumors swirled that Bear Stearns might be forced into bankruptcy, a prospect that sent tremors through the entire financial system. In a desperate bid to stave off collapse, Bear Stearns turned to the Fed for a short-term loan, a move that would later become the catalyst for a historic rescue. On March 16, 2008, JPMorgan Chase announced a $30 billion acquisition of Bear Stearns, a deal brokered under the watchful eye of the Federal Reserve and the Treasury Department. The purchase price, $2 per share in cash, plus an additional $3 per share in preferred stock, was a fraction of Bear's former market value, a stark illustration of how quickly fortunes can evaporate on Wall Street. The acquisition was framed as a preventive measure to avoid a disorderly bankruptcy that could have triggered a cascade of failures across the global banking system. The fallout was swift and unforgiving. Thousands of Bear Stearns employees lost their jobs, while the firm's pension fund, once a beacon of security for its workforce, faced severe underfunding. The collapse shattered the myth of invincibility that had surrounded the Big Three: Wall Street houses, Goldman Sachs, Morgan Stanley, and Bear Stearns, showcasing that even the most storied institutions were vulnerable to unchecked risk, and a culture that prized short-term gains over long-term stability. In the aftermath, regulators and policymakers scrambled to understand how a firm with such a storied legacy could tumble so dramatically. The Securities and Exchange Commission launched investigations into Bear Stearns' use of off-balance sheet vehicles, while the Federal Reserve reevaluated its oversight of investment banks. The crisis spurred a wave of legislative reforms, culminating in the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, which imposed stricter capital requirements, mandated greater transparency, and created the Consumer Financial Protection Bureau to safeguard borrowers. Bear Stearns' legacy endures as a cautionary tale of hubris, opacity, and the perils of excessive leverage. Subscribe to The Collapse for more stories like this.